everybody kind of looks at the same published numbers. And again, once again, I want to caution that these published numbers are not fully informed numbers. There are trades done that people don't see, but let's take those as on face value. We're seeing 2024 a market where we didn't even get close to replacement rate contracting on RFPs and on contracting. So you could deduct from that the utilities aren't contracting. I would argue differently, and I would say their focus was elsewhere. Their focus was more on the UF6 and on EUP. Some of that was as slew of conversion, some of that was as actual products, UF6 and EUP, and therefore the U-Trade component is embedded in those products. But also utilities have taken their time to study the landscape much better. They're looking at the landscape. Okay, who do we contract with? We've got our deals with Orano, we've got our deals with Chemical, we've got our deals with Kazatomprom. Who do we go next to? Where do we want to contract? Do we want to contract with a junior in Africa? Do we want to contract with a junior in the US? Do we want to contract with a junior in Australia?
Hello everyone and welcome to another edition of CEO and Market Expert Interviews. I'm your host Lucian, most of you know me as Triangle Investor from social medias. We are joined today by Bram Vanderelst from Uranium. Bram is also a part of the World Nuclear Association working groups on supply and demand and someone who knows a lot about uranium space. That is why he is here. Bram, welcome back. It is always great to have you.
Thank you, Lucian, to have me back. It's good to be back on the show and discuss markets in a bit more detail with you.
Yeah, I always enjoy that with you. There are actually a variety of topics to discuss around uranium. I believe if we would cover all I wanted, this interview would take some 10 hours or maybe more. But maybe we should start with the year behind us, 2024. Yeah. From your perspective, how would you describe 2024 for uranium, and what were the most significant 2024 events that could shape the future of the industry?
I mean, it's a bit of an understatement to say that 2024 was not the best year if you look at pricing. We spent most of the year in a downwards trend with a few uptrends here and there, but the general trend has been downwards and still is downwards ever since. I think the main culprit to that is the uncertainty in the market. 2024 was really marked by a lot of uncertainty. We saw, the Russian sanctions. We saw the Russian counter-sanctions. We saw uncertainty about where the next capacity is coming from in conversion. We see uncertainty around enrichment, which is what a lot of people or a lot of utilities are currently concerned about. We see uncertainty in the mining sector. Where the next pound is going to come from? Who's going to win the rat race to be the next producer? What's happening with Kazatomprom? Is their sulfuric acid issue solved or not? So I think uncertainty is the best way to describe it. And the second way to describe 2024 is the tiredness of the trade. And what I mean with that is the generalist or the generalist investor or the commodity investor found newer shiny objects to invest in, not to mention gold specifically. And kind of moved away from the uranium trade, which was a hot trade in 2023 and was no longer the hot trade in 2024. And so we saw the investor community largely withdrawing from that market, or at least not supporting the market as they were in 2023. So I think the combination of those were a factor in what happened to the prices, and it kind of exposed the spot market or the market for what it was, and the underlying dynamics, which hasn't really changed dramatically in the last 10 years. You still have a certain cohort of traders who are ultimately hedging or releasing material into the market at certain times in the year, which has an outsized effect on the market prices or the spot market price. And you have not the opposite effect where producers or others are doing the same kind of thing on the upswing. So we're in a spot market that's quite exposed to uncommitted material from primary sources that are filtering into the spot market. And if you don't have the investor cohort or the utilities very active in it, you ultimately have a sort of perennial downward trend in that market. And obviously, I think if I last comment on 2024 would be the normalization of the market. In 2023, we really saw a market that kind of was overheated. We saw a market where everybody was bullish uranium. The spot price massively outrun the term price, which is a situation that typically only holds for a certain period of time, because you then have all the factors that come into play, like the backwardation, and the backwardated trade is much more easy to do in the uranium sector because of the available inventories. So ultimately, you can play with that, and that's really what we're seeing right now is a normalization of the shape of the curve, the contango shape of the curve, which is a much more constructive market for both spot and long term, and which is a kind of this market setup that we've seen for the last 10 years, bar a few episodes where the spot market gets overexcited and kind of runs ahead of itself. So I think that's really how I would unpack 2024.
Great overview. Agreed on everything you said, and I would like to hear more about spot and term market. But before we do that, I have one question. The current hot topic is actually Trump tariffs. Do you see any meaningful impacts on the uranium industry with Trump tariffs and potential trading wars?
Well, it's very hot because as we're recording this, Trump announced the tariffs, I think, over the weekend, and now the tariffs has been scaled back for at least Mexico and Canada for at least 30 days. So at the moment, it's still unclear whether tariffs are going to be applicable, what that looks like. But let's assume that in 30 days, tariffs are applicable, and let's focus on Canada, which is the main topic here. There is a potential 10% tariff of uranium from Canada into the US. My understanding of the tariffs is that yes, it will have an impact. Obviously, there is flows across the border, whether it be mined uranium into the converters, or whether it be UF6 or enriched uranium into the utilities or enrichment centers. So you do have trades on which those tariffs would be applicable. How that is going to be managed and how it's going to restabilize is much harder, because as always, a lot of it depends on how contracts are written, what are the provisions in these contracts, who is ultimately footing the bill for these tariffs. I'm a firm believer that ultimately it's always the consumer who foots the bill for tariffs. I don't think that, as much as you can spin it, I don't think that ultimately the importer is footing that bill, because the importer will just pass on those costs, and same for the exporter out of Canada. So I think there's a lot to be seen. The uranium market, because of its flexible flows around the world, has a tendency to kind of readjust, and that's exactly what it did with the Russian tariffs, or with the Russian sanctions, I should say, rather than tariffs. And so I don't think the impact will be massive, but there will be a period of 6-12 months at least where people are kind of like readjusting how to redirect flows. There is going to be much bigger swap market between the converters. Going to be a lot more readjustments of physical flows. So I think that it will definitely have an impact, but it's unclear to what extent it will have an impact on viability of material or a lack of material in certain markets. I don't think that's going to be applicable.
Yeah, we will follow the story and see what will happen. Let's return to spot. I would like to hear your thoughts on spot going forward. So far, it was a pretty volatile ride. What do you expect for 2025?
I think 2025 is going to be volatile as well. If we dissect spot, we're in a market where you've got two things at play. One hand, you still have the same tendency that we've seen in the last few years, where spot is extremely illiquid. And that hasn't changed. With the uptrend and the downtrend, the spot has been illiquid. We see long periods of time where there's hardly any trade, or people are not interested in doing any trading, and a small amount of material, both on the upside and the downside, can affect prices quite significantly. So that's perfect recipe to get more volatility in the spot market. So I'm expecting that to continue. I don't see the spot market becoming more liquid, unless investors step into the space again in big numbers. We see all the traders step into the space, and there is some rumblings. There's rumblings about more people entering the trade. And uranium has now had 4 years of a general bull market. We've seen a big pullback, so it is not impossible that new hedge funds and new traders step into the space. But for now, I don't expect that to happen anytime soon in 2025. I think the spot market will stay under pressure in 2025, quite frankly. The same dynamics that I highlighted earlier are still at play right now. The sentiment is negative. The uncommitted material that's hitting the market through traders has an outsized effect on spot prices, unfortunately. However, we are getting to prices where the carry trade is potentially applicable again, where it becomes a big question mark. What happens with new production, either from existing producers or junior producers? Are we at prices where a junior producer is comfortable signing long-term contracts? My gut feel is no, or at least this is not the kind of range that we're anticipating signing contracts in. And I think this year will be marked by junior producers either delaying their projects or struggling to sign the contracts at the prices that they want to, which obviously has an effect on the long term, and that then drives the long-term prices in theory significantly higher because the cohort of people that utilities can sign long-term contracts with just narrows down, or they need higher prices even. So that there's a lot of that to think about. So at this stage, I think it's going to be a volatile year. I'm expecting some pressure on the market, but I'm also expecting the fundamentals to come into play, and in that mid 60s, fundamentals really have an important role, much more important than it was in the mid 80s or mid 90s, when there's a bit more meat on the bone for everyone. So I think that really will play out this year in 2025, and will probably establish a real clear bottom in this market where it just does not make sense for people to go below that. And that's not to say that we can't go. No, if I look at the worst case scenario, you can go into the 50s, you can go into the even 40s if there's real disinterest in the market and traders are really actively but what we're seeing so far is that once you get to those mid 60s levels, people step in, and that is because the fundamentals kind of agree with those kind of levels, and obviously the gap between long term and spot opens up wider, which opens up the carry trade again, or is more beneficial for the carry trade. So we also need to look at what inflation does, and what the interest rate does. If there's more cuts by the Fed, makes the carry trade much more achievable. The biggest component in the carry trade is obviously your balance sheet cost, and that is influenced by the Fed US dollar interest rates. So if that comes down, the carry trade can really be a big push for the spot market again.
Yeah, good point. Let's touch more on the term market. I believe that we saw a rise of half a buck reported long-term price. What are you hearing and seeing about the term market, the volumes, RFPs? In general, how are the utilities approaching the market today? Is it business as usual, or we are seeing some sort of a waiting game or something like that?
I wouldn't classify it as a waiting game. I mean, everybody kind of looks at the same published numbers, and again, once again, I want to caution that these published numbers are not fully informed numbers. There are trades done that people don't see, but let's take those as on face value. We're seeing 2024 a market where we didn't even get close to replacement rate contracting on RFPs and on contracting. So you could deduct from that the utilities aren't contracting. I would argue differently, and I would say their focus was elsewhere. Their focus was more on the UF6 and on EUP. Some of that was as slew of conversion. Some of that was as actual products, UF6 and EUP, and therefore the U-Trade component is embedded in those products. But also utilities have taken their time to study the landscape much better. They're looking at the landscape. Okay, who do we contract with? We've got our deals with Orano, we've got our deals with Cameco, we've got our deals with Kazatomprom. Who do we go next to? Where do we want to contract? Do we want to contract with a junior in Africa? Do we want to contract with a junior in the US? Do we want to contract with a junior in Australia? How believable are these projects? And that comes with a lot more due diligence. When you're contracting with Cameco, you kind of almost forgo the due diligence because Cameco is a big enough entity with a high enough credit rating that you don't have to do that due diligence, or at least not to the same extent. If you're looking at a junior with one project that isn't in production, that's in development, there's a lot of work to be done on just pure due diligence. You need to engage mining experts. You need to form an opinion about jurisdiction. You need to form an opinion about time frames. You need to form an opinion about financing. So all of that takes time, and what we're seeing is that utilities are going through the motions, and at the same time they're also playing with the market. And what I mean with that is if the market is dropping, you get better prices, or they think they can get better prices, and therefore the waiting game is being played at, but it's not purely a market-driven waiting game. It's just going through the motions and making sure that everything is covered. And typically, and I've always said this, like utilities work their way backwards. They go fabrication, enrichment, conversion, uranium, and when you've got more stress in that further part of the value chain, you tend to at least not prioritize the front end of the value chain, even though I'm generalizing here. There's a lot of utilities that are fully covered and that are really, really, really smart and that really know what they're doing. So you can't generalize too much, but that's kind of what we're seeing in that long-term market. And the big question mark for 2025 on the long-term market is, does the long-term market hold? Does it hold up? And I always like using them as an example because they always publicly state it. Like Cameco wants floors and ceilings 70 to 130, or that's at least what they've publicly stated. With the market where it is right now, potentially trading close to the floor or under the floor, does that change the dynamic? Do they go to the utilities and go, well, actually 50 to 100 is equally good? Or do they say, no, actually, we've got our contract book, we're happy, we're covered, and if you want something else, we're going to need to bring new production online, and we're going to need incentive prices. And then we stick to our floors and ceilings, or we stick to our fixed price into the hundreds. And the same is applicable for all the juniors and all the other contracting entities. And that's a big question mark, because if all the juniors and all the miners kind of say, no, we need the $80 because simply cost has gone up, and otherwise it doesn't make any sense. It doesn't make any sense to bring a mine online if we're signing $60 base escalated contracts. That gives you that fundamental floor, and that is a clear sign to the market as well. Look, the carry trade should be back in action, because if we're trading 60, nobody else will sign a $60 contract, so you just carry it. And if we're not trading 60, then we're trading higher. So that's kind of like how I look at the long-term market at the moment.
Excellent. Bram, there are a lot of people saying that the spot market is dysfunctional and that it needs more regulation, and with the term market that we need more transparency. Would you agree on any of those arguments?
I think that the long-term market needs a lot more transparency. It's very opaque, and there's a lot of misconception, but I want to qualify that. It's very hard to create transparency if you don't have standardized terms. What we try to distill into one number, which is the long-term number that everybody looks at. What does that really reflect? How can you distill a market-linked price with a floor and a ceiling, a fixed price, a base escalated price, and a hybrid of all of these combined into one number? And it's quite a difficult thing to do. All of the price reporters have their specific methodology, and they give more weight to certain things and less weight to other things. But it's not credible to distill that into one price. And I haven't even talked about credit. It's extremely different for a large utility when they go out and say, Cameco, I'm doing a deal with you, or I'm doing a deal with a junior company that's $20 million market cap. You can't expect the same pricing terms, and therefore when you distill that into one price, you can't accept that one price will reflect both a Cameco deal and a junior deal. Yeah. So in that sense, yes, we need more transparency on long term, but it's very hard to achieve unless you go for a more standardized contract, a more standardized setup, and that's just not relevant for uranium. So I think what we have is as good as it gets, and it's not gonna change a lot. So that's on the long-term prices. Where the spot market is dysfunctional, a lot of the traders that we employ would probably agree. It's dysfunctional in the way that it's hard to trade it. Liquidity is an issue. Price discovery is an issue, even in the spot market. And liquidity obviously is a necessity to have a fully functioning spot market, and that's where the spot market sometimes is called dysfunctional, because people see big moves and they go like, how is that big move possible? On a few £100,000. However, I think the spot market is absolutely necessary. It is your most transparent pricing. It is your most transparent market that you can have a look at. And quite frankly, a lot of long-term contracts gets priced against spot or some form of spot. So it is absolutely critical. I would encourage everybody to trade more on the spot, and I would encourage more activity in the spot because that would help with commoditizing it further. But that needs to be an organic growth as
Of
more
course.
and more entities in the industry are taking part in it. And what we're really seeing, or what we have been seeing over the last years, and I would almost say like the last decade, is that we've seen a consolidation in the trader sector. Independent traders were gobbled up by big large utilities or large producers, and there's a lack of risk in the spot market, meaning that there's less traders who are actively taking risk. One of the best examples, the banks who kind of like got sidelined for a really long time, they were a big provider of risk, and you need that to have a functioning spot market. So it's dysfunctional, but it's not an easy fix. Let's put it that way.
Yeah, and actually there is no initiative to change the format at this moment, right?
I think there's no overarching initiative, and I think we as a physical trader, you can also benefit from the fact that it's that is I wouldn't say dysfunctional, but that it's not as liquid, and that there's informational advantages. Like we have informational advantages by just being active in the spot market and knowing what's going on, and so you adjust your trading style based on how your market functions. In a super liquid spot market, we would trade very different than what we do right now. We're an adaptable organization, and we trade with the tools that we're giving, and that's how you try to get value out of a
Yeah,
market.
yeah. Bram, let's talk Kazatomprom. We saw their Q4 results recently. Joint venture Inkai has resolved the issue and has resumed mining operations. Sulfuric acid problems is still here and probably will remain for the certain time. How do you see Kazatomprom production numbers going in 2025 or even beyond? And do you believe their guidance is realistic?
That's a very difficult question. I don't have any insight in Kazatomprom whatsoever, and getting information out of them is very, very difficult. So I read the same things as everybody else. I Whereas a few years ago we saw them a lot more active through THK, their trading arm. We don't really see that now either. So it's difficult to get a feel for what they're doing through their actions on the market. I would guess that they've learned their lessons in terms of guiding the market, and so I would assume that the guidance they're giving is somewhat decent, and that therefore you can kind of trust it. Once they revise the guidance in 2024 for 2020 for 24 production, they hit that guidance now. They've revised the guidance for 2025, and they reiterated that. So I would imagine that is possible. It's obviously not going to be easy, and there's a lot of geopolitical risks and whatnot, and sulfuric acid, as you said, stays an issue. But I tend to believe that they can hit that guidance. Where Kazatomprom gets interesting is really like looking further down the curve, 26, 27, 28. The question I really have, and it's a question rather than an answer, but is, can Kazatomprom really go beyond the current guidance that they're giving? Can they go up to the 30 to 31,000 tons that they've guided previously? Is that achievable? You've got a lot of the JVs who are they're getting not right now to the end of their life, but they're getting in the next 10 years they're getting to the end of their life. That means that you're typically going into lower grades ore bodies. So on one hand you have the production guidance, but on the other hand you also have the technical limitations on the grind. So that's just a fact. Plus also that these lower ore bodies or lower grade ore bodies consume a lot more sulfuric acid, which is the limiting factor at this stage. So I think it's really a question about where does Kazatomprom guide for 26, 27, 28, and then what does that look like? I think when I speak to investors, a lot of the bear thesis is, but Kazatomprom can just dial it up, and and they're the first quartile production cost, so they can just push the cost curve out, or push people off the cost curve, and that brings the cost down. I don't think that is realistic, but I do think their near-term production is somewhat realistic.
Agreed. Bram, are we in conversion bottleneck, and how do you see conversion and enrichment market in the upcoming period?
We're definitely in a conversion bottleneck, much more than enrichment. Or let me rephrase that. I think the solution to enrichment is much more easy than the solution to conversion. The solution to enrichment is ultimately you play with the overfeeding, underfeeding, and then you kind of like have communicating barrels between UF6 requirements and enrichment requirements, and you can adjust accordingly. So even if your capacity of enrichment shrinks, you can solve it by overfeeding. The problem that you have is overfeeding happens in UF6 format, and to get UF6, you need both your U3 component and the conversion component. And that's where really the bottleneck kind of manifests itself, that conversion is short at the moment across the board. We're seeing little to resolve the conversion bottleneck in the near term. And we're obviously seeing the plants that are active ramp up to the extent possible, or at least to maximize their output. And we see, Converdyne, Cameco, and Orano all maximizing their output to the extent possible. But I don't think it's enough to counterbalance the enrichment necessity, like adjustment necessity, which is also why we don't see as much overfeeding as you would expect, because if you don't have the UF6, there's nothing to overfeed. So yes, we are in a bottleneck. Conversion is in theory the easiest bottleneck to solve. It's ultimately just building a chemical plant, and I probably shouldn't say just building a chemical plant
Yeah.
because Orano has shown us that it's difficult.
Exactly.
But it should be easier than building a mine. It should be easier than building a reactor. But it doesn't mean that you can build a conversion plant overnight. We're still looking at 29, 2030 and beyond for truly new capacity, if that ever comes online. So I think a bottleneck for sure, and it's definitely something that that everybody's aware of, and that does have an impact on uranium as well. Because what's the point in buying more uranium if you can't do anything with it? Having said that, everything's on a long-term market, so you might as well buy more uranium right now on long-term contracts, because why wait until the bottleneck is solved? Once the bottleneck is solved, there's a lot more need for uranium. Prices go up, and then you're bidding yourself into a market that's short on uranium. Then, so you can look at it both ways.
Definitely. We saw the launch of the world's first blockchain-based uranium marketplace. That platform is developed in collaboration with your company, Curzon Uranium.
Correct.
How is that going, and do you believe it will gain traction and become some sort of transparent trading platform?
Yeah, it could be. Look, our involvement is ultimately sourcing the physical uranium that's backing it. So we know for a fact that whatever that people buy on that platform is fully backed by uranium, which was an absolute necessity. We don't want to lend our name to anything that is trying to scam people for obvious reasons. So we want to make sure that it's set up properly. I can guarantee that it's set up properly, and that the uranium that people buy is in storage at Cameco. So I can guarantee that. Whether we'll get traction or not is it's a question mark. It's something that we'll see moving forward. It's ultimately an opportunity to fairly simply acquire actual physical uranium, or the token version of it by retail. So in that sense, it's a competing product to products that are out there, Yellowcake, Sprott, but much more clearly linked to the physical uranium space, with less intermediation and less of the discount and premium to net asset value and all these sort of secondary side effects. So in theory, it's a good way as small retail to own some uranium. I like it a lot. People that I've shown this like it a lot, because it's set up in kind of in a gimmicky, cool way. It's crypto, so it's cool, and that could drive adoption. But when you're comparing it to the Trump token, which goes like 25x overnight.
Yeah.
You can't expect that, because you're linked to a physical commodity. So the question mark is, is it really going to take up because people genuinely believe in the underlying commodity, and retail understands what the story is, and therefore they're looking for ways to get exposure to the story, and this is a very easy, accessible exposure to the story? or are people looking for 25x overnight? And then I would say stay away from it, because uranium isn't going to go to 2,500 in no time.
Yeah, and uranium is not a meme; it's a
No,
real
exactly.
commodity.
It's
Yeah,
it's a real commodity. It's not a meme token,
yeah.
and I think that's important to understand.
Yeah, agreed. Bram, as I mentioned at the beginning of this interview, you are a part of the World Nuclear Association working groups on supply and demand. Can you clarify how is that working? How often do you meet? What are the main goals of those groups?
So the WNA has a biannual publication on supply and demand, which is every odd year, so 23, 25, 27. And what these working groups do, they well, maybe taking a step back, the WNA is an organization supported and paid for by their members. Most entities in the sector are a member of the WNA. We are a member, so all the utilities, the producers, and so it's a member-driven organization. In the supply and demand working groups, what that means is that these members come together, or representative members come together, and form an opinion on what the supply will look like, what the demand looks like. You can imagine, because of the different interests of all the different members, this is a quite heated discussion quite often. But we try to reach a consensus on what is most likely to happen, or what is closest to the truth. We base ourselves on public data. We don't use any non-public data, and therefore the S&D model is a consensus model between all of the market participants, specifically the producers and the utilities, who have very conflicting interest in setting up an S&D model. Let's put it that way. But the output has always shown to be quite accurate, as long as you treat it as a snapshot in time. The WNA meets around 4 to 5 times a year to discuss these things. There's obviously a lot of background discussions or virtual discussion, I should say, on a lot of these items. There's a lot of work to be done. The WNA has their own great staff that does a lot of the number crunching and a lot of the work in the background. But at some point, you need to kind of, same with the balance sheet, at some point you need to close the year and say, okay, this is what we're publishing, and that's typically around the summer periods, right before it gets published in September of the publishing years, and that's a snapshot in time. Anything that comes beyond that is no longer incorporated, and therefore you need to take that with a pinch of salt. And especially right now, the market moves so quickly. There's so much news coming out, so much new policies, so much new builds, and SMRs play a big role. Mines constantly change their mind about when they're going to come into production. So the consensus model is good up to the point that all the data is incorporated, and from that point onwards, you have to overlay your own assumptions. I think that's the best way of putting that model.
Okay, final part of the interview, Q&A. I have some questions from my followers. We will cover them. Okay, the first question. What do you think about Orano's next move? Will they try to buy development companies with near-term production? And where could these potential candidates come from? From the Athabasca or somewhere else?
Orano is an interesting one, because obviously they've lost Niger. They've been kicked out of that country, and they have not been very successful in other places so far. They've had a massive win, however, in Mongolia recently. After years and years of work, they've signed a very wide-ranging agreement with the Mongolian government to the development of that asset, and that's from what I can see, it's a pretty good asset and a pretty conservative development time frame, which I think they could probably adhere to. So obviously, Orano's gone into places that are not your standard locations. I mean, they've also got a JV with Uzbekistan, so they're in Uzbekistan, Mongolia, they were in Niger. They're not looking at the major locations. They've got a big presence in Canada as well, so it's not unthinkable that they're looking at Canada as another jurisdiction to go to. However, Canada is a tough one, because there isn't really lots on the horizon there that is going to go into production in the next 5 years. And if I was Orano, and I'm speculating, but if I was Orano, I'd much rather go into Uzbekistan, Mongolia, where once you're driving a project, you can drive it into completion. Whereas with Canada, there's a lot of uncertainty,
Yeah.
and the big projects are either taken or they're too big. I don't think Orano has an appetite to buy next gen. Denison has got their own development program. Fission is being bought by Paladin. And those are the big three. And anything beyond that, you're looking at a time frame of 10 years
Yeah.
as a bare minimum. So
Probably more.
probably more, exactly. So I don't really see Orano straying from the course that they're on at the moment, which is look for places where they, as a French state-owned actor, can make a difference, can use their geopolitical leverage to a certain extent, and develop projects where others, or at least the public markets, wouldn't go.
Agreed. Next question. Are you bidding down the spot price every month in order to secure lower prices on your market-related offtake agreements?
I'm obviously not going to comment on Curzon's trading, so I'm not going to comment in detail. I know it's a perception in especially the retail community that certain bad traders are unduly influencing the price. What I can say about that, look, at certain points in time, there is more material coming to the market, and when material hits the market, if there's no buyer, prices go down, and that's a simple fact of it. And I wouldn't necessarily classify that as or offering down the market. People should say, but I wouldn't classify it as offering down the market. I would classify it as certain traders who are getting off takes, want to hedge their positions, and are looking for buyers. And when there's no buyers, what you tend to do is look for the next available buyer, and that might be at a lower price. So I think that's kind of what people are seeing, and I think there's a misunderstanding how the market really functions. When you need to do something, or when traders need to do something, you find the price at which people are willing to do something, and it's the same on the upside. When the market in 2023 traded from $90 to $105, about £300,000 was traded, £400,000 was traded, and that is because whoever needed to buy at that point couldn't find a seller, and they just increased price until they found a seller. So it's a long-winded answer to say these are just general market dynamics that are there, and that aren't going to go away. The downside is typically more pronounced, and because you've got more material hitting the market via traders and in an uncommitted way, or more often I should say, then you've got the same effect on the upside, and that's purely because how the market functions.
Okay.
When miners produce, their goal is to get that converted into cash ASAP, and therefore that material needs to go onto the market. If you don't have a contract, it's as simple as that. When utilities need to buy, they typically don't need to buy. They can buy today, they can buy tomorrow, they can buy in 6 months, they can buy in 12 months. And the same is true for most other entities that are on the buy side in this sector, which is why the downward trends is much more pronounced than the same effect on the upside. But we're talking about the same effect. We're talking about illiquidity and finding the right finding the true price discovery at which other entities are willing to do business.
Got it. Next question. Do you believe Aura Energy will be able to achieve a final investment decision before the deadline of March 31st, when your offtake agreement with them reduces to the next pricing bracket of 72.25 per pound?
As an entity to that offtake, I don't have any more information than anybody else, and it'd be wrong of me to have more information. So I can only speculate based on what I see in the public domains communicated by Aura. I think from what I see publicly, they are making the right steps, and they are engaging with debt providers and the likes, which is an absolute necessity to get to an FID ultimately. Whether they can finalize that before the 31st of March or not is in their hands. I wish them all the best with that, and I genuinely hope they get there, because ultimately why we sign off takes is because we want the material. And I'd like to see them go into production, and I'm very supportive of that project. Whether it's going to be before the 31st of March, that's anybody's best guess.
Okay. Next question. With the spot price where it currently is versus term price, do you expect the carry trade to pick up, or do you expect a fairly quiet market as utilities continue to remain on the sidelines?
I expect the carry trade to pick up. With again a qualification, what I mentioned earlier, depends on where the true term market is. If utilities start having the feeling on RFPs and on non-public consultations that they are getting lower long-term prices, then obviously your carry trade is less competitive. But to the extent that the carry trade is competitive, which it currently is for especially the near term, 26, 27, 28, I expect that to pick up because we still see demand in those years. However, what we see a lot is that the demand is kind of like over a longer period of time. So we see demand starting in 27, for example, but going out till 2035. At least utilities are looking to cover further out, and the carry trade can only really play a role in those earlier years. If you carry something at whatever carry trade is at the moment, 7-8%, into 2030, you're looking at much higher prices than a primary would be willing to offer. So I'd classify it as like in the midterm to late 2020s. The carry trade will and is achievable right now and will play a bigger role if we stay at these price levels at least. Beyond that, it's still mostly a producer's market.
Two more, Bram. What do you think about Niger? Is it still investable, and how do you see the future of global atomic?
Is Niger investable? It's very geopolitically driven, so it's tough to call it investable at this stage. Is Niger a good and reliable producing country? Yes, I do think so. They have got really good assets. They have had a history of producing uranium. They've got a history of delivering that uranium to Orano, and so I think everything is there for Niger to play a real big role in this market. However, given the current situation, the difficulty they have with the French, it's a tough one. I think if we focus purely on Global Atomic, Global Atomic has an issue, in my opinion, in that the longer they take to secure financing in whatever shape or form, the more it exposes them to what I would call a downward spiral. Like, we've seen them come to the equity markets fairly frequently in the last few months to keep the project on track, and they need to tap that equity market even much more if they want to keep on track and don't have the financing. But with every equity raise, your equity goes down, which makes it, well, first of all, less attractive on the financing side because you've got less equity to finance against, and less attractive for anybody, for a JV partner, or at least you need to give up more to that JV partner if you were to go down that route. And obviously, the longer that extends, the more you need to you need to do additional deals. And so, I think Global Atomic is coming to a point where they need to decide, we're either gonna wait for this financing, or we're gonna get this financing done, whatever shape that takes, or we're gonna have to say, okay, the project is temporarily suspended until we get that done, because they can't come to market again on the equity. I don't know what it's trading at today, but it's they were trading $3, then $2, then $1, now probably trading around 60 cents.
I believe it's even less, 58, 50 cents.
Yeah, exactly. And so next time you tap the equity markets, you're probably tapping them at 45 cents with a warrant at 80. And you keep doing that, and you're signing your own death sentence. So they've got some really tough decisions to make, and that's I would look at it from that perspective rather than even Niger. Obviously, Niger plays a big role because if it wasn't for Niger, they might have had their US financing. But let's just assume that the situation is what it is. Yeah. The question now is like, how does Global Atomic deal with it? And my personal opinion is that if you tap the equity markets again, the investors aren't going to be kind on you. and it's decision time.
Yeah, it's a tough one. Personally, I see a JV as a much smarter move or much realistic move than the financing. But
yeah, but a JV, I agree with you. But if you look at a JV now compared to when JV was first announced, or at least the potential of a JV was first announced, you're looking at a market cap, and I don't know, I don't have it at hand, but you're looking at a market cap of what, $100 million right now versus 250 when it was first kind of announced. As a JV partner who needs to put equity in the company and provides the debt, how much are you going to take of the company versus back in the day? And you're going to have to give. If I was the JV partner, I would go, well, I want a big chunk of it. I want a lot of it because you're no longer the company that you were 2 years ago, and not just competitive markets. But it's a tough situation.
They don't want 10% or 15%.
No, exactly.
Agreed. Bram, final question. Are the uranium explorers undervalued, and are the developers overvalued at the moment?
That's a tough question. I'm always been very cautious against exploration. Mostly because historically exploration is not done very well, other than a few companies who've actually gone through the exploration phase and actually got things into production. So exploration comes at a massive risk premium, and I think that is what we're currently seeing. If we look at the cycle right now, we're quite late in the cycle, we're later in the cycle than comparatively in 2020 when the market was still trading $25. And so right now it's about getting pounds out of the ground and coming online. If you're a junior in the exploration cycle where your best case is 10 years, 15 years, are you riding the cycle like all the way over the top and back into the bottom? And I think that's priced into the exploration cohort at the moment, and I think that's fair. That's fairly priced. Personally, I don't think the Athabasca Basin, which is where most exploration is at the moment, unless you discover like the biggest deposit in the world, to the kin of what NextGen has or Fission has, the market isn't going to pay for that, and it shouldn't pay for that, because why pay for something when you've got 250 million pounds at NextGen sitting to be developed, 100 and whatever million pounds at Denison, X amount of pounds at Fission? They're all ahead of you in that cycle. So what should the market be paying for? So I think that's how to look at it. Are developers overvalued? I think they are. I mean, obviously they've come down quite a lot with some recent shocks. But I think until recently they were overvalued, simply because there's a lot of risk in a lot of these developers. Again, I don't want to generalize too much, but most developers are still miles away from production. Whether it be technical, environmental licensing, financing, all of the things that we've mentioned earlier. And you can't value them not taking all these risks into account. What I was seeing as well, like if you look at I'm reading PFSs, DFSs all over the place right now. Most of those feasibility studies have significantly upgraded the uranium prices. $70, $80, $90 isn't uncommon anymore. And how realistic it is to get even a $70 across the value chain contract price, I think that's quite unrealistic. It looked a lot more realistic 2 years ago, or sorry, last year. Now it's no longer that realistic, and you got a commodity market, so you're going to peaks and troughs. So you need to look at the full value chain, or the full cycle. And a lot of these companies are saying, well, our NPV is X based on an $80 contract price. Is that realistic over the full life cycle? And I don't think it is. So I would definitely agree that developers are overvalued.
Good point. Bram, thank you very much for this interview. A lot of information was shared here. Thank you for that, and I look forward to host you again. Let's say in the second part of 2025,
Great.
when we will have much higher uranium prices.
When you're able to disprove a lot of the things that I said,
Exactly.
Which is always nice. I always like to be proven wrong.
Thank you, Bram.
Thanks a lot, Lucian.